Friday, May 2nd, and the world is confused. Going back just about 100 years and formalized 50, 60 years ago by an economist named Phillips, we have all assumed that an inverse relationship between unemployment and inflation. That as unemployment rises, inflation goes down. That's the reason that the Fed induces recessions to drive inflation down. And conversely, as unemployment falls, an economy recovers, inflation begins to rise. And yet here we are, unemployment falling, admittedly maybe distorted to the low sixes now, which was thought to be a level at which the Fed would have to begin to tighten to prevent inflation from rising. And buried in today's payroll report, 288,000 new jobs, a boom, full scale underway. Average hourly wages grew not at all. Buried in the GDP report on Wednesday, which was weaker than real, the Bureau of Labor Statistics compiles quarterly employment cost index consisting of wages, salaries, and benefits. And it found in the first quarter of 2014 a gain of 0.3% for the quarter. That would be 1.2% annualized and was the lowest quarterly figure since the BLS began compiling the statistic in 1980. One of the many Barnes theories of the universe holds that in 1990, with the breakup of the Soviet Union and the liberalization of the Chinese economy, about 1 billion new workers all of a sudden hit the global labor pool. Global labor 300 years ago involved sailing ships. Today it involves electrons. And without coercive behavior by employers, just the natural cost sleuthing that's 3 or 4 mouse clicks away, we live in a world that has excess labor. And if there's excess labor, the price of labor falls. So we could be in a place here in the United States in which the unemployment rate falls from the low sixes into the fives, into the fours, into the threes, into the twos. And employers are still not competing with each other for workers. At the point that they have to pay somebody more money to induce them to take the job, they just look someplace else. There's no offshoring. The job wasn't here in the first place. That model is the only one that I know of that explains what we're in and may stay in. The good news is that rates stay down. There's no reason in the world for the Fed to tighten if wages aren't rising. If wages aren't rising, inflation can't rise. A good question would be, how long does this last? And a good answer would be, I don't have any idea. Have a nice weekend.